Welcome to ICAN Intelligence. Today, we are diving deep into IAS 20, which is all about accounting for government grants. We're not here to just memorize rules. We're going to build a rock-solid conceptual understanding so you can tackle any exam question with confidence.
So here's our game plan for today. We'll start with the absolute basics, then get into the rules for recognition. After that, we'll hit the practical stuff, how to account for grants related to assets and grants related to income. Then we'll wrap it all up with the really tricky bits, like repayments and the all-important disclosures. Let's jump right in.
All right, first things first. Before we can even think about accounting for something, we need to know exactly what it is. So what is a government grant, really? You know, on the surface, this seems like a no-brainer, right? A company gets some money or resources from the government. Fantastic. But what's the accounting problem? Well, as accountants, we have to ask, where does this go in the books? Is it revenue from a sale? Nope. Is it an investment from a shareholder? Definitely not. Does it just pump up our equity? This is precisely the puzzle that IAS 20 was created to solve. Okay, let's look at the official definition straight from the standard. There are two golden phrases in here that you have to lock in. First, transfers of resources. This means something tangible, something of value, has to actually change hands. Second, compliance with certain conditions. This is absolutely critical. A grant is never a free lunch. It's earned by doing something or meeting specific requirements. Now, the standard also defines this much broader term, government assistance. Think of this as the big umbrella category. It's any action by the government that gives you a specific economic boost. And this slide nails the distinction. Here's the key takeaway for your exam. All grants are a form of assistance, but not all assistance is a grant. A grant involves that tangible transfer of resources, like cash, that you have to account for. But assistance can be indirect. Imagine the government builds a new road that leads right to your factory. That's a massive benefit for sure, but you don't recognize that road as your own asset. You might disclose it, but it's not a grant. Getting this difference right is a common exam point.
Okay, exam alert. This is a classic examiner's trap. They love to test if you know the boundaries of a standard. Knowing what IAS 20 doesn't apply to is just as important as knowing what it does. So let's be crystal clear. Anything related to your tax bill, like tax holidays or special credits, that's all handled by IAS 12, income taxes. If the government buys shares in your company, well, that's an equity transaction, not a grant. And anything to do with agriculture, like grants for biological assets, has its own special standard, IAS 41. So IAS 20 stays out of all these areas.
Right, so we know what a grant is and what it isn't. Now for the next big question, when we can actually record it in our financial statements. Let's get into the non-negotiable rules of the game. This is the big gateway. Paragraph 7 gives us two hurdles, and you absolutely must clear both of them. You need reasonable assurance. Notice it doesn't say 100% certainty that you'll comply with the conditions. And you need reasonable assurance that you will actually receive the grant. Notice it's not about when the cash hits the bank. You have to be confident about both sides of the deal, meeting the conditions and getting the resources. And this question gets to the very heart of the theory behind grant accounting. Once you've met those two criteria and you're ready to make an entry, where does the credit go? Do we treat this as a form of capital, or do we treat it as income? The standard actually considers two schools of thought on this. The capital approach says, hey, this is just a financing tool from the government. It's not something we've earned, so it should go straight to equity. On the other hand, the income approach says, no way. We earn this grant by meeting conditions, so it should be recognized in profit or loss to offset the very costs it's meant to cover. Now, IAS 20 is very, very clear. It completely rejects the capital approach. It's off the table. So that brings us to the single most important principle in this entire standard. The income approach is mandatory. And what does that really mean? It means we match. It's all about the matching principle. You recognize the income from the grant in the very same periods that you recognize the expenses the grant is intended to compensate.
Okay, enough theory, let's make this real. How do we apply this matching principle to the first big category? Grants given to help a company buy or build a long-term asset, like a new factory or machine. So IAS 20 actually gives you a choice here, two perfectly acceptable methods. Method 1 is to treat the grant as deferred income, basically a liability on your balance sheet. And then you release that income to your P&L systematically over the asset's life. Method 2 is a bit more direct. You just deduct the grant from the cost of the asset right away. Both are allowed, but you have to pick one and apply it consistently. That becomes your accounting policy.
Now let's crunch the numbers and see how this works. This example is fantastic because it proves that no matter which method you choose, you get to the exact same result. Look at that bottom line. The net P&L impact is negative 16,000 naira in both cases. With the deferred income method, you have a big depreciation charge of 20,000 naira that's partially offset by 4,000 naira of grant income. With the deduction method, you just have a smaller depreciation charge of 16,000 naira. The presentation is different, but the effect on your profit is identical.
Okay, that was for assets. Now let's look at the other main category, grants that are related to income. These are grants meant to compensate you for expenses you've already incurred or will incur soon.
And what do you know, IAS 20 again gives us two presentation options. You can show the grant as a separate line item in your profit and loss, something like other income. The argument here is that this makes your main expenses more comparable from year to year. Or you can deduct the grant directly from the related expense. The logic for this is that the expense might never have happened without the grant, so showing the net cost is more faithful. Both are totally acceptable.
Now, here is a very important exception to the whole matching idea. What if a grant is for immediate financial support, let's say after a natural disaster, and there are no future costs to match it against? In that case, paragraph 20 says you recognize the entire grant in your profit or loss immediately. In the period it becomes receivable. No deferring needed.
So far, we've been living in a perfect world where everything goes according to plan. But we all know real life, and especially exam questions, can get messy. What happens when things go wrong? This is where examiners really test your deep understanding.
This is a classic exam scenario. You thought you would comply, you accounted for the grant, you were happily recognizing it, and then you breach a condition, and the government wants its money back. What do you do?
And here is the golden rule, straight from paragraph 32. A repayment is treated as a change in accounting estimate. This is so important. It is not a prior period error. That means you deal with the impact in the current period and future periods. You do not go back and restate last year's financial statements.
So for an asset grant, here's how you handle the repayment. First, you reverse the original entry. You basically add the grant back to the asset's carrying amount. But then comes the really critical part. You have to calculate all the depreciation you missed out on in prior years because the grant had artificially lowered the asset's value. And that cumulative catch-up depreciation, it all hits your profit or loss immediately, in one go. Let's quickly cover a couple of other special cases. What if the grant isn't cash, but something like a piece of land? You simply record both the asset and the grant at the fair value of the land. And then there are forgivable loans. This is where the government lends you money but says they'll forgive the debt if you meet certain conditions. The moment you have reasonable assurance that you'll meet those conditions, you stop treating it as a loan and start accounting for it as a grant.
We are in the home stretch now. Remember, getting the numbers right is only half the battle in your exam. You also need to provide clear and correct disclosures. So let's wrap this all up with what you need to show in the notes and a powerful recap of our strategy. Think of this as your final checklist from paragraph 39. You have to state your accounting policy. Did you use the deferred income method or the deduction method? You have to disclose the nature and the amounts of grants you've recognized. And this last one is so important for users. You must disclose any unfulfilled conditions. This tells the reader that there's a risk this grant might have to be paid back in the future.
And this is it. This is your exam strategy on a single slide. For any IAS 20 question, just walk through these 5 steps. 1. Identify the type of grant. 2. Check the recognition criteria. 3. Apply your chosen presentation method and be consistent. 4. Calculate the impact on P&L and the statement of financial position. And finally, number 5, draft those all-important disclosures. Follow this framework and you will not go wrong.
And that is your complete masterclass on IAS 20. We have gone from the core principles right through to practical exam-level application. If this explainer helped you, please give it a like and subscribe to ICAN Intelligence for more deep dives. For a final thought, how might the accounting change if a grant had conditions that spanned multiple accounting standards? Let me know your thoughts in the comments and tell me which IAS you want us to master next.